Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss Fed Chair Jerome Powell's recent Jackson Hole speech and what it signals about upcoming rate cuts, the bond market, and the overall economy. We'll explore why market confidence in the Fed matters so much for investors, examine the economic data driving policy decisions, and look at what rate cuts could mean for your investment portfolio. Let's start by understanding why the relationship between Fed credibility and market confidence is so important for how monetary policy actually works. While the Fed sets short-term interest rates, longer-term interest rates that affect things like mortgages and corporate borrowing are determined by the markets. This means that the Fed policy only works when investors have confidence in the Fed's ability to achieve its goals. One way we can measure this confidence is through corporate bond yields. These yields represent interest rates that investors require to lend to companies based on risk. They generally fall when the economy is healthy and corporate profits are growing. Today, the market environment is suggesting that this confidence remains strong. Corporate bond yields have fallen and are near their lowest levels in years. Now let's turn to what Powell actually said at Jackson Hole and what it tells us about Fed policy. Powell acknowledged that delicate balance the Fed must strike between controlling inflation and supporting employment. He noted that, quote, risks to inflation are tilted to the upside due to tariff impacts, but also emphasized, quote, significant risk to employment to the downside. Recent economic reports illustrate this challenge. There are early signs that companies are beginning to pass on higher costs to consumers, which could drive prices higher. At the same time, the latest jobs report was much weaker than expected. So the Fed appears to be positioning for cautious rate cuts to balance these objectives. What do potential rate cuts mean for your portfolio? Historically, falling policy rates provide support for bond prices, since existing bonds with higher yields become more valuable. The U.S. Aggregate Bond Index has generated a total return of 4.8% this year, partly reflecting these dynamics. Lower rates typically reduce borrowing costs for companies, which can drive growth. This can also support higher valuations, particularly for growth companies, since lower interest rates mean their future profits are worth more today. Ultimately, the benefits of lower rates will need to be balanced with valuations that are quite high. The best way to do this is not to try and time the market, but by holding an asset allocation that is tailored to your financial goals. We hope you found these insights helpful. If you would like to discuss these topics or your portfolio in more detail, please don't hesitate to reach out. We look forward to speaking with you.